One of the most popular technical indicators has to be the Relative Strength Index, the RSI. And I don't just make that up. I read a survey that was done with the users of the Bloomberg Professional Terminal, and the RSI was the top ranked trading indicator that's used on that platform. And look, you could just toss a dart at any RSI indicator trading strategy, and what is being measured really is just the momentum in that market. The name relative strength may lead some to believe that you're actually comparing two markets, but the RSI just simply compares your market of choice to itself. And the RSI compares the strength of up days to the strength of down days. And with that calculation, we can determine if the momentum that's taking place is either bullish or bearish. And you want to consider lack of momentum as well. In 1978, there was an article that was published in the Commodities magazine by Wells Wilder, where the RSI was introduced to the public, and it was followed up with a book by Wilder called The New Concepts in Technical Trading Systems. And it's a bounded momentum oscillator. It fluctuates between a top level of 100 and a bottom level of 0, which allows traders to use it as an overbought and oversold indicator. And the popular settings to measure the overbought, oversold of an instrument are the 80-20, where the 80 is overbought and 20 is oversold, and also 70-30. Now, the RSI that oscillates using a calculation that compares the relative strength of gains in price of days that close above previous day's close, up days, to price loss on days that close below previous day's close, the down days. And here's the RSI calculation here. And to aid in that calculation, Wilder suggested a look-back period of 14. And like virtually every trading indicator out there, you can tweak look-backs and even the oversold and overbought levels, but there's no magic setting that's going to produce a holy grail in terms of trading success. And if you do decide to tweak the default settings of the RSI, just try to line up the RSI turning points at the 80-20 or 70-30 lines with the turns in the market. And if you do choose to optimize, you may want to test if the time that you spend doing so actually equates to a significant and proven edge to your trading system. And you can actually use our free trading software here to help you in your back testing of your different RSI inputs. And a longer look back is going to ease off on the volatility of the RSI, where a shorter look back is going to see more volatility in the indicator. And the bottom line is that we are using the RSI to indicate the strength in the market, as well as the potential for a turn in the market for any trading strategy. And Wilder did consider oversold and overbought, but not in the same way as it is used today, which is reversal points. For him, either market state would actually prompt a trade in that direction. An overbought market would be candidates for long trades and buy signals. Oversold would be short trades and sell signals. Now, for what we're talking about here, we're going to look at the more conventional method, and we're going to use a look back of 14, oversold of 30, overbought of 70. And we're going to look at these zones for reversal trades. Now, this here is a weekly chart of the United States dollar against the Canadian dollar forex pair, and there are 4 areas that are highlighted. Number 1, after a long run, the RSI becomes overbought and price begins to consolidate and retrace, which works off that overbought condition. And after a 6-month run occurs and we hit overbought again, this time we get a small retrace in price. Number 3, price runs again and we have another overbought condition and we get a 1-week bearish engulfing candlestick that finally turns price. And number 4, price is broken out of a channel, and after a few weeks of just free fall, oversold conditions occur on the RSI, and we see signs of a weekly reversal. Now, note that the 2 overbought conditions did not change the overall trend of the market. And if we were to short on the basis of overbought, and we believed a downtrend was coming because price had a run too far, you got hurt. Price action on the 3rd overbought condition was a telltale sign that the odds were favoring a fall. So blindly trading oversold and overbought levels, as indicated by the RSI, it's not a fully developed trading plan or a trading strategy. Including price action and an oversold or overbought condition on the relative strength index, it's a more refined approach. Remember, the RSI measures momentum, and an instrument with continuing strong momentum will eventually roll over. The issue is that markets can stay at oversold or overbought levels a lot longer than you can keep being a contrarian trader. And here we have a Keltner channel to highlight the point that as a strong market becomes overbought or oversold, it can stay that way for a long time. This is a Keltner channels using 2 standard deviations, and it's a weekly chart. Blindly shorting the upper band or the overbought relative strength index would have been painful. So you want to wait until price action confirms a directional change in the market. And now divergence, and this was probably the first introduction to the RSI back in 78. Quite simply, we're looking for the indicator to diverge from price. So if the market's in an uptrend, we're comparing highs in price to the highs in the RSI. If it's a downtrend, we compare the lows. And here we have an uptrend in price, and the RSI plots the instrument into the overbought area. We know we simply don't just short until we have something to short against. So think of having a confluence of factors coming into play to support that trade. So price puts in a high at number 1 in both price and on the indicator. At 2, we have bearish divergence. Price is pushed to a new high, but the RSI plots a lower high. So is this a shorting opportunity? Well, price puts in a high while we are indicating an overbought condition. Price puts in a higher price high, but a lower RSI high, and has left the overbought zone. Price has breached a potential resistance area, and the reversal candle indicating a failure test of the high. So as price travels down, the RSI pokes into the oversold at number 3 and exits on the next candle. So this can have you on alert for a long trade, but we need something else to back us up in this trade. Now, ranging price action ends with a push down to the top of the oversold area at number 4. Price breaks the previous swing low, but the RSI puts in a higher high, which indicates bullish divergence as price makes a lower low, but the momentum indicator puts in a higher low. You can simply reverse what we just talked about in this opportunity to give you a potential trade to the upside as opposed to the short. Now, this is a perfect example of divergence using the RSI. And there are times where you will get divergence, but price does not react the way the textbook suggests it will. So it's important to have supporting variables to your trading. And this is where knowledge of structure and price action will serve you very well. What about RSI failure swings? Now, this is an interesting use of the RSI, and it may appeal to some traders. What we're looking for is the RSI to fail to surpass a previous high or low, and then surpass a former peak or trough. So think of it as support and resistance failing or holding on the RSI instead of price. At number 1, RSI hits overbought, exits the overbought zone, puts in a lower swing high, and the trade is when the RSI breaks the low as outlined with this black line. At number 2, we drop into oversold and we remain there for a bit. The RSI exits and there is a small swing that plots, and the trade is at the break of that high. Number 3, the overbought zone is exited and the RSI puts in a lower swing high. So the trade is at the break of the low as it's indicated here. So the first trade has you short and you will sit through some sideways price action. So given the momentum move down and then the lack of immediate follow through, this could frustrate many traders. The second trade, it works right from the outset in that there is direct action in your favor. Proper trade management would be vital, especially since price was in a downtrend before you entered. The third trade would be extremely painful to sit through. You enter in a range, even when it eventually breaks, price exhibits a strong rally back to the same zone. Now, you may want to do extensive testing on this type of trading. Now, even from this brief example, you can imagine the host of issues that could crop up that may be avoided if you were tuned into price action and important price structures. Now, traders will also use the RSI as a means to find support and resistance levels that may not be evident on the trading chart. There is no difference with how you draw your lines, as you would do it in the same way as the price chart. Either horizontal lines are used, as well as using a trend line by itself or to help form a trend channel. So using this chart, refer to the arrows in the RSI and follow it up to the price. The one I find the most interesting is the highest peak and where the RSI showed potential resistance at that point. I much prefer using this RSI technique with channels as shown on the right side. And while this technique may have merit, my preference would be to refer to price for support and resistance as opposed to a derivative of price. Now, determine the trend direction with the RSI 50. Now, the period length of the RSI will greatly affect this reading, but if the RSI is above 50, many traders would just consider the market bullish. Below 50, but bearish. Now, the main issue I have with this is that even in a strong uptrend, price will still retrace enough to push below 50. So to add to that problem, in a bull market, pullbacks in price can often be seen finding support at an RSI reading of 35 to 40. In a downtrend, RSI can hit 60 to 65, find resistance, and not violate the determination of a downtrend. So as you can see, there's not too much in trading that's really cut and dry. Looking through the various RSI conditions and compare them to the price in the chart, you can easily see why using price action along with any trading indicator, including the RSI, is a better idea than just taking indicator trading signals. Now, much like support and resistance techniques, using price action is the preferred way. But there are traders that use RSI for chart pattern identification. And I'm not going to show examples of this because chart patterns are highly subjective anyways, but the patterns such as head and shoulders may be found in the RSI window. Let's wrap this up. The RSI, it's pretty versatile. And the simplicity and the apparent robustness can be intriguing for further testing if that's what you want to do. Now, perhaps there's merit to slightly optimizing so the oversold and overbought of the indicator lines up with recent swings in the market. This would probably be something you'd want to do on the higher time frame charts, like the daily or the weekly, as intraday has many more swings to contend with. There are other popular look-back periods in the RSI, such as 9 and 25. But again, this is something that you're going to want to test before you're implementing it in your trading. Look, technical analysis, it's not an exact science, and you will never find the perfect indicator setting. So the biggest takeaway is just make sure that you have fully tested your trading plan when you're using the RSI or any indicator. It's a lot of work, really, but without testing it, you're not ever really going to fully trust your trading strategy, and you're never going to allow it to reach its full potential.